understanding today's borrower. I'm Tammy Schultz, the Executive Vice President of Sales and Marketing for TruStage. I'm excited to kick off today's discovery session regarding something core to TruStage, credit unions and your members, but more specifically around lending or financing, the things they need or want, and the insights consumers have about the lending experience. I don't know if you heard, but TruStage celebrated a pretty big birthday this year. 90 years of working with credit unions and partners to reach more people in more ways to make sure that they have access and options to products and solutions that help them make more confident financial decisions at every stage of their life. Whether it's buying a car, consolidating debt, covering emergency expenses to navigate the unexpected, replacing your furnace that went out on the coldest day of the year, loans and credit are deeply woven into the fabric of everyday financial decision-making for consumers across the United States. If I had to guess, most of us on this call have relied on a loan at some point in our lives. Today, loans are not just a means to access money. They play a key part in how consumers manage life's transitions, navigate uncertainty, and build toward long-term goals and financial stability. That's why at TruStage, we spend significant time and resources researching people that borrow money and their needs and preferences for lending options and the experiences they expect. At TruStage, we understand why it's more important than ever for organizations like ours to show up for you, our credit union partners, with data, analysis, and support that helps you make good decisions. In fact, at Discovery, our expectation is that you walk away not only learning something new you can share with your colleagues, but having data and insights at your fingertips to take action and to bring ideas forward to your management team, your board, and to make these sessions come to life. We are excited to introduce our latest proprietary research at TruStage that is intended to give you knowledge to help make better decisions, have access to the data to make your lives easier in the roles you play, and to help you see around the corner to what's next to be proactive versus reactive. This is our third iteration of the comprehensive quantitative study. We started it back in 2019 and we repeat it every other year. This research is aimed at understanding consumer experiences, preferences, and the emerging opportunities in the areas of lending and solutions that help those consumers keep up with loan payments when life gets in the way. Our targeted insights are from consumers that are currently either engaged in or have recently been active within the loan market. We work with research partners to obtain a sample that represents consumers across the U.S. amongst different aspects like age, household income, race, and gender. I'm happy to have two of our TruStage resident experts in the lending space here today to share the latest research on the borrowing consumer, what they're feeling, what they're thinking, expecting, and preferring in their experiences. Craig Meyer is our lending segment leader and a vice president at TruStage, with responsibilities for leading the digital, product, underwriting, and partner teams. In this role, she focuses on helping protect consumers with payment protection products. Corinne has held numerous leadership roles in her time at TruStage, including credit union sales, product management, partner management, and the consumer business. Erica Romanesco is our senior manager of customer experience and brings a deep passion for understanding human behavior and decision-making. She leads efforts to apply both qualitative and quantitative research to better understand members' needs, motivations, and their preferences, particularly when it comes to loan-related and financial decisions. Besides being TruStage colleagues, the other thing we have in common is we are all CUDE best class ever. So now it's time to turn the program over to our resident experts, Corinne and Erica.
Thanks, Tammy. Excited to be here today. So let's talk first about how are consumers feeling about loans. The good news is we're seeing a rising recognition that loans play a key part in financial well-being. More and more consumers view loans not as a negative necessity to life, but a tool to help navigate life's financial challenges. In fact, in 2025, you can see in the top bar here, 80% of consumers believe loans help them build financial well-being throughout their different life stages. We're also seeing an increase of using loans to help with debt consolidation. Consumers are actively looking for ways to simplify their finances and regain control. So loans are really a smart strategy and not a burden. While we see this positive energy in these top results, it's also important to know that taking out a loan remains a major financial decision. And you can see that here in the middle row, one of the biggest decisions I've had to make. And current economic pressures like inflation and interest rates, which you'll hear more from Steve Rick, our chief economist, in a later session today about, are definitely pushing consumers to be more thoughtful about getting a loan and seeking and making them more open to things like protection that you see in the bottom row. We've seen an uptick in interest of things like GAP, mechanical repair coverage, and payment protection. Consumers are really wanting that peace of mind and safeguards to help them weather that uncertainty overall. And what does that uncertainty look like? Well, what we saw is 9 out of 10 consumers are worried about their ability to make their loan payments. Let's sit with that for a little bit, right? They have this worry that a life event could impact their ability to make a loan payment. They're feeling financially stretched. And as you start to absorb this slide, you might see and feel like it's a little busy, and that might be by design, just to really reflect how many things consumers are worried about today. And if you take in the slide, one of the things you'll notice is from 2023, those blue bars, to 2025, each one of them has increased. Consumers are feeling more worried than they ever have before. You might be wondering, what's the biggest jump we've seen since 2023? And that's job loss, up over 23% in just 2 years. Close behind, we saw seriously ill, damage to vehicle, natural disaster, all had a 20-point increase in being worried. And while that might be interesting, I think what struck us the most was just the vast array of things consumers are worried about. On average, they selected 6 different life events that could put their financial stability at risk. So consumer concern is not only growing, it's really broadening. They're feeling vulnerable on multiple fronts and looking for ways to have peace of mind and offer up, we have the opportunity to offer up protection to help them with that overall peace of mind. Let's dig a little deeper. Where do these concerns come from? Well, the reality is 73% of borrowing consumers have experienced one or more past financial difficulties. So for many of your members, it's not a question of if, but more of a question of when. What are some of those top financial burdens? You can see here on the slide. 36% have missed a loan or credit card payment. 30% have had a negative impact to their credit score, while 24% have not been approved for a loan. This really underscores how financial challenges have really long-lasting impacts and consequences to their overall financial security. And as you look at those top causes, they align with what people are worried about. Their inability to work due to illness or disability, losing a job, and those natural disasters. So we have this great opportunity. We have this opportunity to help consumers proactively plan for the unexpected. So while past experiences, like the 24% experience an illness or the 23% having a job loss, and have been through financial hardship, many still worry about the what if. You can see here, it's almost double to almost triple the worry about the what if this could happen to me. So what does that tell us? Consumers are thinking ahead. They're not just worried about today's reality, but also they're worried about tomorrow's risk. And I think, as an industry, that gives us a powerful role to play. We can clearly see some opportunity here. Not only helping support setbacks for those who have had an illness, disability, or job loss, but helping those who are concerned proactively prepare for the unexpected, making sure that they feel that peace of mind and confidence when taking out a loan. But it's not just about the numbers. I also believe it's really important to hear real voices. So at TruStage, we not only do qualitative research, but also quantitative research, and here you can see a little bit of how that qualitative research is coming to life, right? We sit down with real borrowing consumers and actually listen to how they describe in their own words what's going on in their financial lives. And it's really emotional insight that's crucial to helping us form the complete picture of the borrowing consumer of today. And so as we saw in the quantitative research, there's this worry that comes through. And we definitely hear that in the qualitative research as well, but it's definitely not the whole story. In these conversations, we consistently hear something else. We hear hope. You can see that here on the consumer on the left as they describe the picture of their current financial status, saying, I can touch the ground of the swimming pool. People also, have expressed this deep sense of responsibility and pride. They want to do the right thing. They want to stay on track. They want to improve their credit. And you can see that a little bit on the consumer on the right-hand side here. I'm really proud of what she's achieved. So understanding this nuance of both the stress that we hear in the quantitative research, as well as this hope we hear in the qualitative research, really helps us design better solutions and experiences. We can bring through empathy and really understand every data point is a human with a story. So as we close out this section about how are consumers feeling about loans, we're going to dive a little bit more now deeply into where they're deciding to borrow. Where are they getting those loans? So let's start with what type of financial institution consumers are using. And you're going to see here we're continuing to see some notable shifts. But before I dive into those, I want to remind you of what Tammy mentioned earlier. This isn't a survey of all consumers across the United States. It's really looking at consumers who have recently obtained a loan and or are in the market for a loan. So for those individuals, what type of financial institutions are they using? What you can see here is a drastic increase in the use of online-only banks from 16% in 2019 to almost 54% in 2025. That's a significant jump. You'll also see a minor drop for both credit union in the light blue, as well as regional and community banks in the dark green, while you see a slight uptick in the large national banks in dark blue as well. In addition to which type of financial institution they're using, we also wanted to understand how many financial institutions are they using. And what you can see here in looking at the pie graph is 60% of the consumers we surveyed are using 2 or more financial institutions. Well, many are using multiple financial institutions. I also think it's worth noting that 40% are using one financial institution type. So as we look at that 40%, we tried to dig into which type of financial institution are they using. You can see here large national banks are the most single-used financial institution type, with over a quarter of consumers using only that type of financial institution. While a little alarming was that credit unions were least likely to be the only financial institution that consumers were using at 13%. So what does that mean? That means 87% of credit union members have accounts with other financial institutions. So it might not be a total surprise, but borrowers are likely also doing business somewhere else. On a more positive note, what we also found in the study, though, is that consumers are more likely to want to use their primary financial institution for kind of their next solution or service. So let's take personal loans here. Starting with kind of the plan to obtain group. So what are those who are interested in getting a loan expecting to do? You can see here, starting on the left-hand side, 21% say, I'm not going to do any research. I'm just going to go use that primary financial institution. The second bar at 29% say, I'll research some options, but still have a preference towards that primary financial institution. So 50% have a bias towards using that primary financial institution when planning to obtain a loan, while the other 50% is much more open, planning to do more research, look at other options. Now, if we look at those who just plan to obtain and we bring in those that recently obtain, what difference do we see? Well, we see that consumers were less likely to actually do research. And 40% of them went with their primary financial institution. And as you look at the rest of these and bring them in, what you see overall is that 70% of them obtained that loan with their primary financial institution. And in general, they did less research than they expected. Now, if we look at home equity loans, we see a very similar situation where more of them went with their primary financial institution. However, there was a little bit more research done with those type of loans. So what does that tell us? That tells us that trust with the primary financial institution where they already have a relationship matters. The trust your existing members with you have matters. What does it also tell us? Convenience matters, right? They're less likely to do research if it's convenient for them to get the loan. So it's important as credit unions we're looking at what are those moments that matter to my member? How do I invest in things like real-time marketing to connect with them in those moments that matter the most? Let's also go a little bit deeper now in auto loans. So as we went out and we talked to individuals who were planning to obtain a loan, about 80% of them thought they would get a loan from the dealership. When we talked about to those who had recently obtained a loan, about 80% of them got them from the dealership. So what they expected to do and what they did was very similar. Dealerships play a really important role in the auto financing ecosystem overall. But as we dug a little bit deeper, there's a couple nuggets in here we thought were really interesting. For those who did get a loan from a dealer, 43% of them, which you can see on the left-hand side of the screen, were matched with a bank or credit union through the auto dealership. And as we looked at that segment, we asked them about their openness to doing more. And this was another bright spot for us. 74% of those indirect consumers were open to doing more with the credit union or bank that they were matched with. And I know historically, finding efficient and effective ways to engage with an indirect member has been perceived as challenging. But I think this data suggests there's a real opportunity. Consumers are willing, maybe even expecting, to engage more if we meet them there. So I see this as a big opportunity for us to continue to look at how we deepen relationships with those indirect members overall. So we've now taken time to understand how consumers are feeling about loans, understand where they're getting their loans from. I'm going to turn it over to Erica Romanesco, who really is the leader behind this research and has been doing an amazing job with it to help us better understand borrowers' preferences and expectations.
Thanks, Corinne, and thanks, Tammy, for that super warm introduction. I'm excited to share what we've learned from this year's research about borrowing consumers' expectations and their preferences. And what was very clear this year was that consumers' borrowing expectations are not just about experiences made digital or loans being made faster. They're expecting this seamless digital experience with the ability or the reassurance that real human help is always within reach. And so let's dig in. How did we arrive at this kind of conclusion? So there were several questions and ways we ask borrowing consumers about their channel preferences, and this is one of the most direct. We ask consumers, what do they prefer when it comes to the channels across the steps to get a loan? And you can see here in that darker green, that's consumers who say they prefer more in person. In the light green, they are preferring to go online, but they still want some human help. And blue, they're saying they want no help from a human. They want to be online. And gray is they don't have a preference. So what might surprise some of us is, again, despite the rise of everything digital, there's a pretty strong majority of consumers who still prefer channels where they can get some real level of human help. And this is true across almost every step of the borrowing journey. The only real exception you can see here is when consumers are just researching loan options. And at that stage, some do prefer to be more just online without any human help. But we look at the blue and there's still a quarter, 25% or so of consumers who do prefer to do everything online with no human interaction at all. And that's a significant group we can't forget about too. So this is the challenge to institutions like TruStage and lots of you, credit unions and partners. Lending institutions have to be good at serving both ends of the spectrum. Those who want a fully digital self-service experience and those who still value or perceive, we'll talk about that in a little bit, higher quality when they can have some human help along the way. So what is up with this ask for still wanting human aided help? We also ask consumers to tell us, what do they think is better when it comes to applying for a loan? Again, in person, you're going to see in the green, or online directly in the blue, or in the middle. Equally good is the purple. So you're going to see here, again, 53% perceive in person as providing the better customer service and answering questions. And you see more of the online strengths for in saving information to update or change options or compare options. What strikes me too is looking at this is how many just say equally good in the purple. And this is what I find challenging for us. And when I talk to credit unions is how to understand perception. There was some research done a couple years ago for a self-service like online investment platform, and they were able to do a true A/B test of consumers' behavior when the investment platform had a chat with an expert button. So the test that included the chat with an expert button well outperformed the one that didn't have it. So those who saw that button and they just had this perception of human help, and they made more investments and more trades in that online platform. The catch was very few actually used it. I can't even remember what the percent was, but they didn't even actually chat or talk with an expert. It was truly just the sheer presence or the option to have a human to talk to that mattered. So this is a challenge, right? We can't just assume that using something and looking at those metrics is the only one to use. We have to dig a lot deeper to understand what's really mattering to consumers and these preferences. So one question I always get when I share some of this research is, do these preferences vary a lot by age? And the short answer is somewhat. We do notice that older borrowers tend to believe more often that in-person interactions offer a better customer experience. But interestingly, more than half of the youngest borrowers also feel that in-person service provides the best experience. And then you can look at, when we look at ease of applying, perceptions are kind of consistent across all age groups, except for we do see some of the oldest borrowers thinking that it is easier to actually apply in person than online. We also asked which of the following, if any, do you expect during the loan process when you're applying for a loan? And consumers who took this survey, they could answer, they could pick anything that they thought from a list. And these are just the three that involve direct communication. So aligned with what we just talked about, 8 in 10 consumers expected when they're applying for a loan to have at least, again, the perception of being able to communicate directly with a person. And we do see some differences across loan types, personal loans, auto loans, home equities. We do see higher expectations sometimes with home equity loans to get that kind of representative help. So this is just more data and research to bolster the need for why seamless channels and why we've got to find ways to provide the expectations that these consumers have. So what about expectations for speed of approval? So interestingly, when we averaged all the loan types, the expectation for same-day approval or denial has remained steady between 2023 and 2025 at 56%, with auto loans showing that highest consumer expectation for a quick approval or denial. So while speed remains a very important and growing in significance, it's still important to consider what other growing expectations lenders may be falling short on. And this year, much like 2019 and 2023, when we did this survey, consumers continue to prioritize the monthly payment and interest rate when they choose a loan. We ask respondents to select the most and the second most important factor that influences their loan decision. And this data is showing the percentage of people who ranked each factor as either their top or their second priority. And what's interesting this year is there are these other factors that have increased since 2023. So you can see, we just talked about approval speed, opportunities to save on an existing loan, and additional loan options. So this suggests that the right payment amount and a great rate remain critical, but they're not only the only deciding factors for consumers. They're looking for more. And again, this increasing consumer expectations for what they're wanting in their loan experience. Well, let's get to some more exciting stuff. How do we actually use research to design better borrowing experiences? Well, before we dig into some examples, let's frame three simple, overlooked steps that we always use to evaluate and improve consumer experiences. So first, analyzing with a multiple lens approach. Corinne and I have shared a lot of quantitative insights, hard numbers, statistical significance, which I love. They're really key to designing experiences, but we want to emphasize the value of using other approaches and combining several methods. So quantitative research, like we've been talking about, can give you those solid, measurable trends, impact across a large group, and it's really great for spotting where big opportunities lie. But I think Corinne said this, numbers alone don't tell a full story. So that's where the qualitative research comes in. So we listen to consumers' own words, their emotions, and we try to uncover the why behind their behaviors and the stories that really bring all that data to life. Then we look at in-market data to see what consumers are actually doing in real-world scenarios, and that really helps us catch things that surveys or interviews are likely to miss, since people don't always actually do what they say they will. Another factor that we're leaning into is behavioral science, which is incredibly powerful for understanding the psychological factors that drive consumers' decisions. And it helps bridge that gap between intention and action and guides us to design experiences that feel natural and are supportive, but also get consumers to do the things that we want them to do. When we put this all together, we rely on CX or customer experience principles and tools, and then you're going to see a little bit more about how we use UX that then takes all of these hypotheses based on research and go test them with real consumers and be able to refine experience to better meet their needs. I think the hardest part of this process is prioritize. We want to always do everything all at once and improve the entire experience, but we all know when everything's a priority, nothing is a priority. So in another piece of this, if you're changing everything all at once, it's pretty hard to understand what is the change that actually drove the behavior that is to improve. So we really try to focus on what we're going to prioritize to change. And lastly, test, measure, learn, and improve and repeat, right? This is just the process we're constantly following with all this research to put it into practice. So let's take this to a specific example here. So for us at TruStage, we could use this quant research we just talked about to spot some pretty big measurable trends. Corinne talked about this, that 9 in 10 recent or soon-to-be borrowing consumers have a concern about their ability to make a loan payment if a life event happened. We also saw that 82% would be interested in electing protection on their next loan. Again, that's sometimes intention doesn't always meet action, but that's a pretty strong relevance percent to say 82% would be interested. And we also know that only 5 in 10 recalled being offered protection. So this is where we see a big opportunity, right? It helps us spot where we've got an opportunity to fill. So payment protection is relevant to consumer needs, yet we know we've got an opportunity to make it easier and consistent to make them aware. In this survey, we also ask a little bit deeper on specific protection preferences and where to focus. And in this year and in previous years, we asked consumers at what points in the loan process do you prefer to learn about protection? And they can pick as many options as they want. And what you can see here is pretty clear. They don't just want one moment to learn. They want multiple touch points throughout the process. And it also points out a pretty big opportunity. 60% of them preferred to learn about protection during the application process. I'm going to pass it back over to Corinne, and she's going to share some examples of how we've used all this research to lean in and learn from some things at TruStage.
Thanks, Erica. Yeah, let's go from kind of how we take research into actionable results that help protect more of your members and help drive more non-interest income for your credit union. So first example I'll use is this notion of, hey, I want to learn about payment protection before my loan is finalized. So as we think about the digital channel, at TruStage, we think it's really important to integrate into your credit union's digital loan application. A great opportunity to help the members learn more about payment protection before the loan is finalized. So when we first started this, we launched with adding a payment protection advertisement at the bottom of each step of the loan application. And you can see here at initial launch, we had 2% engagement. We knew from some of those stats Erica just talked about, we should be doing better. There's more interest in these products than we have. And so as a next step, we worked on kind of creative design. How do we make it more eye-appealing? How do we make it clear to the consumer what these benefits are? And we got up to 8% engagement. I like to joke, right? We quadrupled our results. That's amazing. But we still thought we could do better. And the real unlock here is when we started to test where in the digital loan application should we place the offer. And we went from placing it on every screen, which you think would be optimal, to actually only placing it once. Placing it after the consumer had filled out the loan application before review and submission. And so when we just placed it in that one spot in the workflow, we optimized our engagement to over 40% engagement consistently. That's a great example of the power of kind of taking the quantitative study, using UX design and testing to optimize overall results and unlock value. So this really was around where to place it. Let's talk a little bit about how we used research on how we talk about payment protection. So from the 20 plus hours of qualitative interviews that we did and behavioral research, we heard consistently that generally consumers feel positive about the idea of payment protection. And you can see here on the right-hand side of the screen, a real credit union consumer talking about the benefits they could see in these products, because as we talked about earlier, they felt and seen a real financial setback before. And so this notion of, hey, consumers are often motivated by the desire to avoid negative outcomes definitely came out in our interviews. And behavioral science calls this the prevention mindset. So because of this prevention mindset, consumers generally feel positive about the idea of payment protection. However, it was mixed with some skepticism. So it's really important for us to get underneath what was that skepticism so that we can provide overall peace of mind. And when you look at the overall skepticism, it comes through in things like, well, I'm interested, but I want to know more. What does it cover? What doesn't it? And they felt like they needed more detail before they could really make a decision. And as Erica mentioned earlier, what really came out of this was understanding the top two things that consumers wanted to know. What is it? Kind of what does it cover and not cover is number one. And number two is how much does it cost? And so really focusing, and as Erica mentioned earlier, prioritizing, making sure we are really clear about what is it and how much does it cost in our digital content became a core of the team's focus. And so, we were looking to improve in kind of two key areas as we went into further testing. It was how do we convey value in a way that feels intuitive and resonates, so really thinking about transparency. And second is how do we overcome that skepticism by building trust. So one example of kind of a design test we did was about how to display cost to the consumer. And so our very first test we used was including the cost as part of the loan payment. Now, for those of you who offer payment protection, probably feels pretty natural. Your loan officers do this on a daily basis. When we put this in the digital channel of talking about the cost as part of the loan payment, it didn't go well. In fact, many members were found it confusing and deceptive. And it took us a while to figure out why that was. And it was because in the digital channel, we really needed to separate kind of how much did it cost, the amount of money it cost so they could determine if it was value, from how they wanted to pay for it, which was part of the loan payment. Now in the face-to-face channel, loan officers just do that very naturally, in their conversation. But digitally, we really needed to separate those two concepts of what does it cost versus how do you pay for it. So that led us into more testing on what does it cost. And we started to test kind of per day versus per month. And very clearly, as we got into the per day versus the per month, we found per month won out, right? It was very equatable to what my Netflix subscription is, how much my loan payment is. It helps the consumer transparently understand, do I find value in this product given the cost? And later, we can get into how to pay for it as part of their monthly payment, for instance. The other thing we know is that, especially in the digital channel, when you have more brief interactions to share with the consumer, to overcome skepticism, we also found additional touch points mattered a lot. And so for consumers where they just saw the education in the application, what is it, how much does it cost, we saw 26% of those individuals electing payment protection. But when we added another touch point, when you saw it in the loan application and we real time followed up with an email message that provided more information about the products, took you to a landing page with testimonials, really taking the time to allow you to learn and educate yourself more, we saw improved take rates. So instead of 26, we saw 37% of the time members were taking out the coverage. And that's really pretty impressive, right? Those multiple touch points increase the consumer confidence and increase take rate by over 40%. So thinking about how you best connect with your members is really important. And as we've kind of taken to market our digital integration that includes education and quoting now, we now have over 650 credit unions using our embedded digital content with education and quoting. We just surpassed over 3 million applications where these payment protection products have been offered digitally, and are proud that 96% of credit unions would recommend these digital integration capabilities to others. So, when you can combine kind of qualitative research with real consumer testing and deliver results is something to get really excited about and celebrate. But in addition to doing kind of consumer level testing here at TruStage, we also do a lot of credit union and market research as well. And late last year, we went out and talked to credit unions across the United States to understand, where are you with your digital journeys and building out digital loan experiences? And you can see here for auto loans particularly, about 53% of digital loan applications are starting digitally. And 23%, so less than a quarter, are ending digitally. But we also asked, where do you want to be 3 years from now? And 3 years from now, credit unions would like about 75% to start digitally and over 50% to end digitally. So a lot of growth here in digital investment, definitely going into helping credit union members complete digital experiences overall. We also saw a very similar trend when it looked at payment protection. So across all loan types, the desire to have more digitally enabled education, but also purchase, increase over the next 3 years, where you can see over 50% of credit unions expect that digital purchase experience over the next 3 years. So that's really an area we at TruStage have been focused on here in 2025, is to say, how do we fully enable payment protection to be sold digitally? So not only can I learn about payment protection, understand how much it costs, but I can also pick a plan. I can decide if I want life insurance or life, disability, and unemployment. I can understand I'm eligible based on how many hours I work or my age. And I can ultimately elect coverage digitally and serve the appropriate disclosures to feel confident in buying payment protection digitally. So we're super proud to roll this out this year, and we have a spotlight session coming up this afternoon that I definitely recommend stopping in at so you can see the new functionality and how it will come to life both for your member and your loan officers so that we create a strong digital multi-channel experience overall. And then the last one I would hit on is another area where we're focused here in 2025. You heard me talk a little bit earlier about kind of the indirect borrower, and that our research revealed that 75% of indirect borrowers were open to deepening their relationship with your credit union. And we feel like payment protection is a great opportunity to do that. So in April, we began testing with debt protection, offering it to indirect members, real time as they come into working with your credit union after getting the loan from the dealership, and have seen some really positive early results around engagement there. So we'll continue testing that here in 2025 and look forward to sharing results more with you at a later date. So hopefully those give you a couple examples of how you can take quantitative research, qualitative research, and design practices to deliver really strong solutions to credit union members overall. So with that, I will turn it back over to Tammy to close us out.
Thanks, Corinne, and a big thank you to Corinne, to you and Erica for sharing your insights today. So I know we heard a lot, so I thought it would be helpful if we summarized some of the big key messages that we wanted you to walk away with today. So the first was around this confidence. You heard us talk a little bit about the different relationships and different touch points, but how do you make sure consumers feel confident in their borrowing experience? The second, you saw that different ages, different people, they like to do things different ways and probably multiple ways. So how are you looking across the different channels? So being able to show up where and when it matters. And then finally, finding those ways that make you unique in building those relationships with your members. And finally, it's not about just checking a box. I think back to Corinne, your example of what if we would have just left it right at the beginning or on every page and we didn't go look at the data to tell us. So while you might institute something or test something, make sure you're going back and looking at how do you continuously improve. So like I mentioned earlier in our conversation, my hope for you today was that you're walking away from today's session with things you can do today with the information you learned. You also have ideas on how to leverage this data to shape your member experience and growth strategy. And finally, what is some thought leadership that you can take back to your management team or your board that you learned today? And if you thought this was a great session, be sure to dial into some of the other sessions you heard us reference so that you experience the same level of takeaways. So thank you for taking the time out of your busy day to come learn with us. If you can't tell, we're pretty passionate about the work we do with credit unions and their members to make sure that we further meet consumers' needs. Enjoy the rest of Discovery 2025, and now we'll take a quick break.